President Trump says you should put your money in the stock market because he just posted this quote, "You better go out and buy stocks now, because let me tell you, this country will be like a rocket ship that goes straight up." Now, if you're wondering if you should take President Trump's advice and put your money in the stock market, you are in the right place. And let's start by taking a look at history. Because 1 month ago, President Trump said the same thing. 1 month ago, President Trump posted this. "This is a great time to buy, exclamation mark, exclamation mark, exclamation mark." 4 hours later, that very same day, President Trump announced a 90-day pause on tariffs, and that pause then sent the stock market soaring. The stock market jumped up by almost 10% that very same day. But this time is a little bit different. So what I want to do in this video is break down what's really happening in the stock market right now. That way you can make smarter decisions with your money and hopefully more profitable investments. But I can't tell you what to do because, of course, I'm just a random guy on YouTube. I'm not a financial advisor. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Right now, everybody on Wall Street is holding their breath until July 8th. Why July 8th? Because July 8th is when the 90-day tariff pause is going to come to an end. And if the tariff pause ends and we find out that tariffs are going to be much higher than expected, that could cause Wall Street to panic, which could send stocks lower. If tariffs come in less than expected, that could cause Wall Street to get excited, which could help the stock market soar. We don't exactly know what's going to happen after July 8th, but we're starting to get some hints from the president and the White House. How do we know? Because President Trump just posted this, quote, "80% tariffs on China seem right." Now, 80% tariffs are very high, but they're not as high as where we are right now, because right now we have 145% tariffs on China. And President Trump also said that the final tariff decision is, quote, "up to Scott B." That's Scott Bessent, who was a Treasury Secretary. So there is still a lot of uncertainty with where tariffs are going to go. We're starting to hear that we might be seeing more trade deals, meaning lower potential tariffs, but we don't know exactly just yet. We're going to find out on July 8th, but tariffs aren't the only thing that investors and Wall Street is paying attention to. Now, these are things that we all cover in Market Briefs. Again, Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in the economy, the stock market, the housing market, crypto, and the global economy into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that read Market Briefs every morning. Plus, when you join Market Briefs, you'll also get our investing masterclass free as a bonus just for joining Market Briefs. So if you want to stay up to date on what's happening in the markets, plus be a smarter investor, Market Briefs and the Investor Masterclass can help you with that. So if you want to get it all for free, all you have to do is click the link down in the description below. So if we put tariffs aside for a second, the other thing that many people are paying attention to is interest rates, because that also impacts our economy. Now, when I say interest rates, I'm not talking about the mortgage rate or your credit card interest rate. I'm talking about the interest rate that the Federal Reserve Bank sets. Now remember, the Federal Reserve Bank is the central bank in the United States. They're called the Federal Reserve Bank, but they're technically not federal. They're not a part of the United States government. They're not a reserve because they're not sitting on any cash reserves, and they're not a bank because you and I can't go there to deposit money, but they also have the ability to monitor and control our money system. And they control what's called the federal funds rate. This is what interest rates mean when you hear CNBC talking about interest rates, or you hear the financial media or the government talking about interest rates. They're talking about this federal funds rate. And this is the interest rate that banks charge each other when they lend each other money. And the reason why this matters is because it's almost like the wholesale cost that banks have to pay to borrow money. Because if banks have to borrow this money at a higher interest rate, they then ultimately charge you a higher interest rate when you get your mortgage rate, or you get a business loan, or you get a car loan, or you get a credit card. So when the Federal Reserve Bank raises interest rates, your mortgage rate and your car loan rate and everything else goes up. When the Federal Reserve Bank cuts interest rates, it gives the banks the ability to charge you less interest rates when you borrow money as well. That's why a lot of economists and investors and Wall Street are paying attention to the Federal Reserve Bank's interest rate, because they want to see if this is going to help stimulate the economy soon, or if interest rates are going to stay high soon. And the Federal Reserve Bank just met, and they said that they do not want to cut interest rates because they're still concerned about inflation because of tariffs. Here's what Jerome Powell, who is the chairperson at the Federal Reserve Bank, had to say, quote, "If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment." What does that mean? If tariffs stay around, according to the Federal Reserve Bank, inflation will go up, the economy will slow down, and people will lose their jobs. That is the definition of stagflation. Now, stagflation is a worst of all worlds when it comes to a recession, because now the prices of things are going up while the economy is slowing, while people make less money. And obviously, nobody wants to see that stagflation happen. But again, we don't know if the tariffs would cause that. And we also don't know if the tariffs are going to stick around and how severely they're going to stick around. This is why I say Wall Street is holding their breath until July 8th, and they're trying to pick up the hints that Wall Street and the White House is publishing regarding trade deals, but we won't ultimately know until July 8th if the tariffs are going to be around and how severe they're going to be. But what we do know is that interest rates are going to stay higher for longer, because Jerome Powell, who is the chairperson at the Federal Reserve Bank, said that because of the concerns of tariffs and inflation, he does not want to cut interest rates right now. And of course, President Trump has some strong words about this, because he believes that the Federal Reserve Bank should be cutting interest rates to stimulate the economy. Here's what President Trump said. Quote, "Too late, Jerome Powell is a fool who doesn't have a clue. Other than that, I like him very much." He went on to say, President Trump, that, quote, "Oil and energy are way down. Almost all costs, like groceries and eggs, are down. Virtually no inflation. Tariff money is pouring into the United States. The exact opposite of, quote, too late. Enjoy." Essentially, President Trump is saying that the Federal Reserve Bank should be cutting interest rates because the prices of things are falling, inflation is no longer a problem, and money is coming into the country because of the tariffs. And that's what President Trump says, that the Fed should be cutting interest rates. But the Federal Reserve Bank, remember, is not a part of the federal government. And Jerome Powell says that he's not going to change his policies just because President Trump is saying so. Which then brings us to the most important part of this video. What does this mean for you as an investor? Well, the key word here is as an investor. Traders are trying to time the market. They're trying to guess what's going to happen. It's a form of gambling. I'm not a trader. I don't advocate for trading. And, well, I wouldn't make money as a trader either. But as an investor, all this means is nothing. Because when you're an investor, you're investing for the long term. And we're not just talking about 6 months or a year. We're talking about many years. And we don't know what's going to happen. Either the economy is going to boom, the economy is going to crash, or it's going to go sideways. But what we know is over the long term, the economy will probably continue to grow. I mean, that's what we've seen happen over the last 100 years. And if I had to put my money on it, I believe that the economy is going to continue growing over the next 10, 20, 30 years as well. So if you believe that the economy is going to continue growing over the next 30 years, what happens over the next 3 years isn't so important. Maybe the economy will grow, maybe it will crash, maybe it won't grow that fast, it'll be kind of sideways. But in any case, my goal as an investor is to accumulate ownership in good assets, period. And the way that you do that is either by consistently putting your money into investments, or by finding good investments and buying them when they're on sale, or when I believe it's a good buying point. That's really it. And so now when a lot of people get panicked and freaked out about what's happening in the markets, or they get very excited when markets are rising, you end up now becoming more of a trader than an investor. And this is where I want you to take a step back and understand your goals. Is your goal to allow your money to grow and build wealth over the long term? If so, you shouldn't worry about the day-to-day news. You don't need to worry about tariffs. You don't have to worry about all the little things going on. All you need to do is stay calm and keep investing your money. And you got to know your strategy, of course. If you're just dollar cost averaging, I call it ABB, always be buying into, say, the S&P 500 or the total stock market. Well, now all you keep doing is sticking with your strategy and keep buying more shares of the United States economy. And if markets crash, you buy even more. If markets boom, you continue buying. But the only time you really change it is when you go through that downturn and buy more aggressively, because it gives you the opportunity to buy more pieces of the economy at a discounted price. If you want to be a little bit more involved, what I call looking for market shifts, you're looking for more niche opportunities. It's not for everybody, but for some of you who want to be more involved, who like that sort of thing, well, now what you're looking for is, where is the money moving? You're trying to find those opportunities to see where money is moving, and then that creates an investment opportunity for you. Now, of course, this is where you also have to analyze the stock. You want to be able to run the financials and do all of that. I cover this in some of the investing masterclass if you join Market Briefs, but the whole idea here is you're looking for where the money is moving. You want to find a shift, do your research, and then invest in the opportunities that you believe fit your investment portfolio, that you believe will make you more money in the future, and then you stick with it. A lot of people get caught up in the emotion. I want you to be a financially savvy investor, not an emotional investor, because an emotional investor is a trader, and traders are oftentimes just gambling, trying to figure out how they can make some extra money. I want you to grow your wealth. It's a very different mindset, and it's been proven that investors make more money than traders over the long run. Traders can make a lot of money very quickly, but what we've seen is that over the course of 10 years, the vast majority of traders end up losing money. They end up in the red. I'd rather you make money over the long term. Investing is a much slower process. It's not as attractive, it's not as exciting, but it builds more wealth. So you pick and choose. Do you want to have a lot of fun, or do you want to get rich? You get to decide. And for some people, especially the people that follow this channel, investing can be fun too. And with that, I'll see you on YouTube Monday.